I don't know about the 333 rule, but when I was in banking, started with banking, we had the 363 rule. Do you guys remember that? You take money on deposit at 3%, you'll end up back out at 6%, and then you're on the golf course by 3 o'clock in the afternoon, right? That was the old way of doing banking. So I want to talk about some fundamental shifts that we're seeing in retail banking. Shifts that we've seen in other industries before, but in the context of what's happening in the banking industry, are going to be very disruptive. It's going to change our view of retail banking forever. Now, just let's look at the basics of this. According to the World Bank, 60% of the world doesn't have a bank account. 60% of the world's population is unbanked. So if you want to get a bank account into the hands of these billions of people, how would you do it? Well, obviously, one way to start would be looking at the mobile as a platform. Now, we talk about mobile banking and things like that, but I want to put this seed in your thought. If you want to transform banking for the globe, then the mobile phone is going to be the vehicle for doing that. And remember that thought when we get to the end of the presentation today, because that's a key thought. Now, if you look at emerging markets, emerging market use of smartphones is actually happening faster than in the United States, which is phenomenal. The highest per capita penetration of mobile phones is not in the United States. It's in countries like Singapore, Hong Kong, United Arab Emirates, economies that we would previously have called developing economies, but are certainly developed economies today. In 2 years, 80% of the Chinese population will have a smartphone. At that point in time, there will be more smartphones in China than toilets or bathrooms, right? So, interesting statistic. Now, if we look at other markets like Kenya, this is a very interesting market. Only 20% of the population in Kenya have a bank account. But M-Pesa, which is run by Safaricom, the mobile telecom in Kenya, came along a few years ago, 2006 it was, and said, we would like to enable mobile money transfer through the phone, text messaging. So you can walk into an M-Pesa outlet like this, you can give 2,000 Kenyan shillings over the counter, and your friend receives a text message on their phone. They don't have to have a smartphone, just be a normal feature phone, saying, you've received 2,000 shillings. You can then, as living in Kenya, take your phone to an ATM machine and withdraw that money out of an ATM machine using your phone. Or you can walk into a store, an M-Pesa store, and there's 38,000 of these, local stores, grocery stores and retailers that support M-Pesa, and you can buy goods and services over the counter using your Nokia feature phone. That's how you send money in Kenya. You text it. But here in the United States, the most developed economy in the world, we still have to write a check. Right? It's intriguing, isn't it? These changes are happening all around the world. We're seeing behavioural changes. Here in the United States, we've had a very interesting development with Square. Have you guys heard of Square? So this is the fastest growing merchant solution in the world. They have now about 3 million merchants on this platform. And by the end of this year, they'll do about $15 billion in payments through the Square platform. But here's the thing. A lot of people think the reason Square has been successful is they turned a smartphone into a point of sale. I will put it to you, that's not the great innovation of Square. Think about a small business. If you guys are in the commercial business, think about this. You're a small business and you walk into a community bank that's commercially focused and you say, I'd like to get one of these credit card machines for my store. What's the process? Oh, well, how much are you going to put through the merchant account? Because, you've got to have a minimum level of business, otherwise you don't qualify. That's the first hurdle you've got to get over. And then here's a contract from Amex, here's a contract from MasterCard, here's a contract from Visa, here's a contract from Discover, here's a contract from the bank, and we need a deposit for the point of sale, and if you don't use it enough, we'll take it off you. Square said, forget about that. Go online, download the app, we'll send you this plastic dongle 3 days later, you're good to go. Square's greatest innovation was getting rid of the friction in merchant onboarding. Now, if you think about these changes happening in the business right now, we are an industry that is in love with friction. In fact, we have a special word for friction in the banking industry. It's called risk mitigation, right? And we've been so used to this. When new compliance rules come down and things like that, what do? We say, oh, well, we'll just pass on the workload to the customer. These innovative organisations that are going for our deposits, our customers, our business right now, they're attacking friction. And our instinct is to say, we can't change that because compliance and legal will never let us do that. But we have to start thinking differently about this type of engagement because consumers aren't happy. They're voicing their dissatisfaction with the friction in the system. And this friction is resulting in loss of trust in banks and the industry as a whole. The friction is really the core thing. Now, when new innovations come along that potentially can reduce friction, what's our instinct as an industry? This is never going to change the industry. People aren't going to use a mobile phone for banking, come on. It's not the way this is what Bloomberg said when the iPhone came out. Bloomberg said it's not going to make a mark on the industry. And yet the smartphone has made the biggest mark in the last 100 years in terms of consumer behaviour of banking than any innovation that's occurred. Paul Volcker, the ex-Fed chairman, he said the last great innovation in banking was the ATM machine. Well, I think this is a pretty significant innovation. Now, this has produced some changing behaviour. We've seen a rapid decline in customer in-branch transactional activity over the last few years. Now, between 2000 and 2010, we saw a 40% reduction in branch transactional activity. This is average numbers across the United States for all FDIC-insured institutions. But 2010, we saw a rapid decline between 2010 and 2013. What caused the rapid decline? 2007, the smartphone was introduced, the iPhone. By 2010, smartphone had reached mass adoption levels. So that was the trigger for that shift. And that's a key transformational behaviour. Because if you looked at those figures that Shankar showed earlier, what we know as a basis of this is that 22% of branches do less than 3,000 transactions a month. And that roughly correlates with about the 25% of branches in the United States that are now no longer profitable. That's a big number. At least 25% of branches in the United States today aren't profitable. Within 3 to 5 years, it's going to be closer to 50%. So how many branches will we close as a result of changing consumer behaviour? Now, I know what you're thinking. You're thinking, that's fine. If people aren't visiting branches to do transactions, that's okay. We can still sell to them. But this is core behavioural shift. Look at the change in behaviour around cheques. We've seen the same shift in behaviour. We've seen a dynamic shift. And for those of us who are used to writing cheques and using cheques in our daily life, this may seem, the concept of having a world without cheques might seem foreign to us. But most other countries in the world have already done this years ago. In fact, US today represents 2/3 of all cheques written globally. And there is not one country in the world, not one country in the world, where cheque use is increasing. It's only going one way. And let me tell you, it's not going to stop. This trend is not going to suddenly stop and reverse and people are going to start using checkbooks again. It's never going to happen. This is going to start speeding up rapidly over the next 2 to 3 years. Now, I'll explain why this is a problem in a moment. But this shift is really a behavioural shift in terms of the way we do banking. So, this is the only deposit product in the United States today that's growing. Checking accounts shrunk last year by 4%, but prepaid debit cards grew by a massive 25%. This is the only deposit product in the United States today that's showing any growth, and it's growing by 25% a year. Now, what we know about prepaid debit cards is that there's a number, of course, of what we would traditionally class as underbanked or unbanked consumers that are using this product. But here's a very interesting thing. According to the CFSI, half of this group that uses this product are college graduates. And around 30% of the users of prepaid debit cards are prime credit rated. Now that goes against our instinct, because our instinct suggests that people who take these products are people who can't qualify for a typical bank relationship with a checking account. But that's not what we're seeing. We're seeing consumers specifically opt out of the traditional bank system and go to a prepaid debit card as a bank account alternative. Why? This group of customers that take these products have something all in common. And it's not necessarily their income that's the issue, or their salary. They all have in common that they don't use checks. Now, the first thing that happens when a Y-Gen in the ages of 20 to 30 walks into a traditional community bank, the first product we try and sell them is a checking account. And their instinct is never to write a check. And you say, but it's okay, they're free, free checking. They don't care. Because instinctively, I'm not going to write a check. I don't need a checkbook. Why do I need a checking account? I just need a card that I can use online. I need to be able to go into a store and pay for stuff in a store, and I need to be able to get cash out of an ATM. Why do I need a checkbook? You are not suitable for me. This account doesn't work for me. But you get a card with it. Yeah, but checking account, it just doesn't work. The name of the generic product, the basic product we're selling to this next generation of banking customers, we're selling the wrong product. We're not selling something that instinctively they understand. Their behaviour's changed. As a result, we see dramatic shift in core branch behaviour. In 1995, I would visit a bank branch. If I'm an average retail banking customer in the United States, I'd visit a bank branch somewhere between 20 and 26 times a year. Today, that average last year was 3.2 visits a year annually. That's an 85% reduction in the number of visits per customer per year. Now, we see that played out in the transactional activity, but it's going to have an impact on revenue. Now, I know some of you are probably saying, well, that doesn't count for my region, doesn't count for me locally in the community. We still get plenty of people in the branch. But think about who you have to the branch today. Are you getting new customers, the Y-Gen, the next generation of customers? Are they the ones that are still coming into the branch every week? Or is it your existing customers? Because remember, they are a shrinking demographic. Now, I know they've got assets right now. But by 2020, when half of the retail banking population are Y-Gens, you're going to have a problem if you don't have the revenue cycle sorted out. And this is not a strategy for increasing branch activity, by the way. B of A might have thought it was, but I don't know. So this is the challenges that we're seeing. This is what the data is telling us. There is a shift. So by 2016, we're going to see 350 digital interactions with a community bank in the United States for every one face-to-face interaction. This is the challenge. I'm going to be using my phone with a mobile app on my phone 30 to 50 times a month to interact with the bank. And I might log in once a week, maybe twice a week, visit an ATM, might call a call center, but I'm going to visit the branch, 2016, this is just 3 years away. Might visit the branch once or twice a year. Now, if you think that those 2 visits to a branch in 2016 is where the magic happens, this is where the relationship is going to happen with the customer, and there's another bank who's really, really good at doing mobile, and they're interacting with that same customer 30 to 50 times a month, what chance do you think you'll have of defending your relationship with the customer if you only see him in a branch twice a year? That's the challenge we face. A fundamental shift in day-to-day banking behaviour. So by 2015, 70% of this next generation of banking customers will be mobile first. That means they'll use mobile as their primary day-to-day banking channel. For the rest of us, it's only going to be a year later when most of us will be using mobile as our primary channel. For some of you today, you may use mobile as your primary channel. Go and ask the younger members of your bank, the younger team members within your community bank. Go and ask them how they do their banking. Ask them how often they visit the branch. Even if they're in the bank, they're an employee of the bank, you'll find their behaviour is already exhibiting what we're seeing for the rest of the Y-Gen So what does this all mean? This group of customers fundamentally think very differently. They on average send about 100 text messages every day. In fact, their use of text messaging has just started to decline because of tools like Snapchat, Facebook chat, and so forth, where they're now sending messages via this platform in a very different way. So how are you going to deal with these kids who've grown up with technology? Remember, internet is not new for these kids. A mobile phone is not new for these kids. Social media is not new for these kids. It's just their way of life. You know what is new? When you tell them to come down the branch and sign a piece of paper, that's totally foreign to them. They just don't get that. So how are you going to deal with kids who've grown up with technology like this? Where's the button on the iPad? So she soon tires of this because she's just not getting the response out of these that she wants. She wants to go back to the iPad. Listen to the reaction. She loves it. So it's not my daughter, it's actually a friend's daughter, and she's about 4 now. There's going to be a stage when she's embarrassed about the fact that I show this video at these sorts of events, but hopefully that's in a couple of years' time. So the instinct of these kids coming into the banking system now is very different. Their instinct is not to write a check and do the things that we used to do. In fact, they might have trouble understanding what these two things had in common. Or recently I found out from a colleague he had to show one of his younger colleagues how to put a stamp on an envelope because they didn't know how to do that. Right? You use this to message your friends? How does that work? And in the same vein, why we use this to watch videos, and you had to rewind it before you took it back to the video store. You remember those days? They used to fine you, right? If you didn't take it back rewound, you'd get a fine. And in the same vein, you see these things that I'm talking about here. You get that, right? But guess what? In the same vein, it's the same for checks. This is actually a credit union in the Midwest running a training session teaching kids how to write checks. I think they've missed the point. Trying to get our kids to behave like we behaved, that's like now trying to get them to use a landline instead of a mobile phone. Or use a cassette tape instead of downloading their music on iTunes. They just instinctively don't behave the same way we do. Why should we be trying to force them into a system that we might have been quite comfortable with in the past? So smartphone penetration is going through the roof. We see this. Tablets are growing faster than even smartphones were. 1 in 2 US internet users will own a tablet by the end of this year. That's pretty impressive. Just to illustrate this, tablets are growing at basically twice the rate smartphones did. Smartphones are growing at about 400% the rate that internet adoption grew at. We see this rapid quickening of these adoption of technologies. So that means you've got less time to adapt to things like mobile payments, which are going through the roof right now. Look at this. PayPal had $14 billion in mobile payments last year. And they expected to be $43 billion this year. Now, if you're in a business like Starbucks, where 35% of transactions in a store are done on a mobile phone, you could be forgiven for thinking that mobile payments aren't something in the future that you have to worry about, that they're actually mass adoption right now. You would say if a third of your customers use a mobile exclusively to pay, you would have to say that mobile payments are not a future thing, right? Here's a very interesting thing. We saw the stats. Right, there were over 5,000 financial institutions in the United States that were under $500 million in assets. You saw that number in that chart? Starbucks last year took $2.2 billion in deposits. And they're a coffee company with a gift card. $2.2 billion in deposits off the mobile platform, off the app. So wouldn't you like to have $2 billion in deposits for your community bank? The problem with this is, what's the difference between a Starbucks app, which you can use as a debit card in a Starbucks store, or an iTunes account, which you can use to pay for stuff in an Apple store? What's the fundamental difference between that and a debit card that we get issued from a community bank today? It's a value store. You can use your phone to pay. What if Starbucks started to link in with other stores? What if they linked in with the Merchant Exchange, with Walmart and those guys? It's a value store, works just like a bank account. How would you differentiate that from a traditional checking account? Well, it doesn't have checks. Yeah? So this generation communicates differently as well. Their selection process of banks and organizations, brands that they want to work with, is fundamentally different from previous times. Previously, we'd be able to send out these advertising messages and get a great response, but these kids, they communicate with each other, and that's what influences their choice of service organizations to work with. So we hear all the time about the PC market dying, right? You see, there's one company that doesn't seem to have a problem with selling PCs because of word of mouth within this group. You know, if you're a university student attending college today and you had an Asus, you know, IBM compatible Windows computer, you'd want to stick an Apple sticker on it just so you didn't look out of place, right? And the same vein, they choose things like restaurants based on their friend's recommendation. This is extremely powerful in influencing their choice of brands. And you can bet this is going to influence their choice of retail banking service providers as well. Because they trust what their friends say every time over what you say in a newspaper ad or a billboard or a TV commercial. You can say, we're the best bank, we've got the best rates, we've got the most ATMs in this part of the world. You can say all that stuff. If my friends tell me your bank sucks, it's not going to make a difference. So how are you going to get this type of advocacy, this groundswell of support, so you can attract these new customers coming into the banking market over the next 5 to 10 years? This is a really big challenge for us. Now, there's a whole lot of technological development at the moment which is very interesting. This is the Scanadu tricorder. What you do is you connect this to your mobile phone, and you hold this device up to your temple, and it gives you all the same data as you would receive on a heart rate monitor in a hospital. It can tell you your heart rate, you know, all this data, biometric data, in real time. Fascinating technology, fascinating. This is a personal medical device. Now, what would a health insurer, do you think, pay to get access to this type of information? Or maybe the E39 shirt from Under Armour. Do you guys heard of Under Armour? They're a big competitor to Nike in the sports clothing brand. This shirt, you wear this shirt and you see it's got some yellow pads in the shirt. These are data collectors. And this thing in the center, which sort of looks like an Iron Man thing, this is a sending unit which sends data from the shirt to your iPad or your mobile phone. So you can see how many calories you're burning, your heart rate as you're exercising. A coach coaching a professional football team can get 2 athletes to run the length of the field, and even though they run the length of the field in exactly the same time, he can tell by which athlete's heart rate returns to its resting state quicker, who's fitter, based on the shirt he's wearing now. Amazing data. Think about this. The real data we want to make critical decisions on risk and lending and these types of things in the future won't be something like a credit score. It'll be financial behavior. How much money you spend, how much money you save, how much control you have. And for our customers, they're going to want that information too. It's not, advice in the branch is not going to be the big thing in the future. Advice, real-time advice every day as I use my bank account. That's really what will make a banking relationship clever, smart, intelligent. This is the new advice. Think about it like the fighter pilot with a head-up display. You know, if you're spending too much money, you're not going to be able to afford your rent, and you walk into a Best Buy and you're about to buy a flat-screen TV, maybe your bank should be telling you shouldn't make that decision. But maybe a customer might not like to be told that. We just don't know how these interactions are going to change in this rich data environment, but they will change. And tools like Google Glass, this is part of this rich overlay environment which is going to really challenge the way we deliver context of banking, context of the product. You see, we don't buy a mortgage, we don't buy a credit card, we don't buy a car loan, we don't buy travel insurance as retail banking consumers. They're not the products we buy. We buy a home. We go shopping. We buy a car. We travel. They're the activities we do, and the bank facilitates our life financially within that context. We've fallen in the trap of thinking that our products as a bank are special enough that we can stop you from buying the home, submit you to a risk analysis process, and maybe, if you're lucky, we might let you have that home loan. That's friction. That adds no value in this new world because our customers are going to discount our brand, discount our way of doing business if we obstruct their life with our products instead of enable their life with our products. And that's the challenge we really face. In an environment where regulation is increasing and we're trying to mitigate risk and satisfy regulators, we're introducing more and more complexity into the system when consumers are looking for simplicity and context. And that's a dramatic challenge. Now, the problem is that these new non-bank FIs and others who are getting into this mix, they're circumventing, to some extent, that complexity because they're building a new layer on top of the existing banking system. Players like Square, Simple, Movin, GoBank, Bluebird, Prosper, Lending Club. All of these organisations are attacking the same problem, complexity in the system. So if you can't step back from that complexity that you have within the bank today and look at ways of reducing complexity and improving customer engagement, making it simpler and easier for your customers to engage with your bank, you are going to be challenged in the future by changing consumer behaviour. Now, I know the instinct might be to think that the regulators might step in and save you here. But understand this, two things. One, the regulator at heart wants the US economy to be the most efficient banking system in the world. So they're not going to stop innovation. But the bigger thing to realise is bank regulators don't regulate consumer behaviour, and they never will. So if consumer behaviour changes, if I told you the only place you could buy a book was in a bookstore, you're not allowed to buy a book online, you know, how long is that going to last? You can't fight consumer behaviour. Look at the Recording Industry Association of America. When Napster came out, that's exactly how they responded. Legal threats against Napster. They brought Napster down. Yeah, we've won. We've saved our traditional distribution system. How long did it last? How long were they successful? They spent tens of millions of dollars. They couldn't stop consumers from just that simple desire to download music online. You're not going to be able to stop the instinct of this next generation of customers who want to pay with their mobile phone. That's a shift. So is this how you still measure high-quality service engagement in the branch? See, our customers now increasingly are measuring high-quality service engagement like this. You see, if I can fix the problem on my phone, and I know I should be able to fix it on my phone, but you say, no, I'm sorry, you're going to have to come into a branch to fix that. Is that good service? Or are our customers going to say, what a hassle. What a hassle. You know, a lot of consumers, when you ask them about visiting a branch today, they'll say, I hardly ever go to a branch, but sometimes I have to go because there's no other way to get it fixed. That's a very common discussion you'll hear amongst consumers. And this is how we want to talk to customers. Right? Rich customer advice. Advice is what makes a difference. Advice is what differentiates the branch, right? You're not going to get advice from a phone. You're not going to get advice from an iPad. You're not going to get advice online. This is what's going to save the branch. Advice is where the differentiator is, right? That's the common thing. The problem is 9 out of 10 of your customers, if you ask them, will probably tell you they've never received advice in a bank branch. Now, okay, don't believe me. This is how they get advice today. They talk to each other. They look at peer group reviews. They speak to their peers. And we've now got social networks that provide a platform for that type of interaction. Advice is changing. We can even talk to our phones now, and they'll give us advice. How to drive, where the nearest Italian restaurant is. You know, this is a dynamic environment. It's very interesting. When we think of technology in respect to banking, we often think of our old IBM XT computer with the 5-inch floppy drives. We think of it as cold, hard functionality. When we think of something like an IVR system, we think of press 1 for credit cards, press 2 for account balance. Yeah, really clunky stuff. But you've got 13-month-old kids who can pick up an iPad and use it without even thinking about it today. Technology today is far friendlier, and it's becoming very human. Now, I know your instinct around advice. You want to get these kids into the branch so you can give them advice. But think about this. This is a generation of kids who are growing up who are very, very comfortable with technology. So comfortable that this is the type of music concert that they go to today. So this is a Japanese avatar. Her name is Hatsune Miku. And she was created as an advertisement for some voice synthesis software. The single that they used to advertise this voice synthesis software was so popular online that they released an album. The album was so popular, they decided to do a concert series. And Hatsune Miku has done concerts in 16 different countries. And she's, on average, she gets over 10,000 people at her concerts. The only thing is, you can see them in the audience. She's an avatar. She's a computer program. Now here you're thinking that advice in the branch is a differentiator. It's special. These kids are going to love to come in and speak to someone. Come on. They'll go and see an avatar perform a music concert. Do you think that a human face is really going to be what brings them back into the branch to have that interaction with you? They think differently. Now, this is a shock for some of us, because our instinct would never be to go to a concert like this, right? But this is nothing unusual for them. They're quite comfortable with that. We need to change our instincts as a bank. Their instincts have already changed. We need to start to change our instincts. Branch is not necessarily, this face-to-face interaction is not necessarily a superior engagement for this generation. Let me sort of summarize it for you and crystallize really the key issue here. Do you remember these? The old passbook. You had to go into the branch to get them stamped. Well, this one was handwritten, as you can see. You used to go in and... Actually, there's another interesting story. If you want to know where account numbers came from, research B of A's first mainframe computer that they put in place. The reason we have account numbers today is because that computer, when you added new customers to the ledger for B of A, they couldn't automatically sort customers by their name. They had to do it numerically, so they had to add in an account number. Before that, we just had index cards for each customer in the branch. So this was our bank account in the 60s, right? And our instinct for banking was a passbook. Now, in the 70s and the 80s, our bank account changed. Our primary bank account artifact became a checkbook. And today, our primary artifact is what? A debit card. Yeah? And today, you can get these debit cards increasingly They're readily available. You can walk into a Walmart or a CVS or a Duane Reade. You can pick one of these off the shelves. But this is the primary representation of our bank account today. I say that because we use this as a bank artifact as a retail banking customer more than any other artifact associated with banking. We use this typically at least once a day. But how often do we visit a branch? Not that often. So this is our bank account. What's the bank account of the future going to look like? It's not hard to guess, is it? It's going to be a smartphone. This is going to be the bank account of the future. Passbook to checkbook, checkbook to debit card to smartphone. But once you eliminate the need for a physical product in a physical store, and distribution of this is just a download of a bank account onto your phone, how is that going to challenge the physical environment, the physical branch distribution structure? Now this is, actually I wanted to show you guys this. This is actually a receipt in real time from Movin, which is the financial services lifestyle product we've built. We sit on top of banks. We've got a couple of bank partners, CBW in Kansas, Bank of the Internet, Webster's Bank. We sit on top of these guys and provide a basic bank account on top of their infrastructure. But we own the customer. And on my phone, you can see a MasterCard PayPass contactless sticker. So I go into a store, and if they have contactless, I present the phone, and I get this receipt pushed to the phone in real time. Now what this receipt shows me is it shows me how much I've spent at the store for this purchase. It also shows me how much I've spent at this merchant in the last 30 days. It also shows me how much I've spent eating out, which is the category of spend that I've spent in the last 30 days. So at a glance, I can find out how I'm using my money. Every single time I use my bank account, I'm getting feedback on how I'm spending money. Now think about this. Unconsciously, we do activities like buying a coffee at Starbucks every day, and we don't think about this too much. Or maybe catching a taxi, if you're in an urban area. We don't think about those types of activities every day. So when you walk into a Starbucks and you pay with Movin, and you find out you've spent $7.50 on a coffee, but that month you've also spent $248 in Starbucks that month, that might be a surprise to you. Because your old bank account never gave you that sort of information. In fact, your old bank account never gave you advice at all. All it told you is whether the transaction was approved or declined. Now, if you're trying to improve your financial health, if you're trying to save money, do you think this type of tool might help you to understand your spending habits and help you to save money? How effective do you think this type of tool would be versus coming in and speaking to a banker in a branch in respect to giving advice? I would put it to you, this is far more constructive advice than coming into a branch and speaking to someone over the counter. Mortgage purchase aside, all of those things, this is real advice. This is how you can really connect with a customer on a day-to-day basis. So this is the evolution of the bank account. The challenge for us is, well, the organizations who are really challenging the traditional bank account at the moment aren't in fact banks. People like PayPal, Bluebird, Amex, Walmart, Movin, Simple, Starbucks. These are the guys who are playing with different modality of payments on a day-to-day basis, the core bank account activity. Now, I know what you're going to think. Yeah, but when this person, if a person's using this product, they're going to need a mortgage someday, they're going to need a relationship with a bank. They're not thinking that far ahead right now. The big problem you've got is that deposits are going to move to this type of smart bank account. And I sort of played with this. I think a smarter account makes a smarter bank. I'm playing on our play with the bank directors here. If you guys want to check out Movin, right? Because you might think of us as a competitor, but again, we sit on top of partner banks. If you'd like to partner with us, we're absolutely open to have discussions on that. But if you want to check out Movin and how it works, that real-time receipt experience, getting that smarter bank account feedback, that advice every single time you pay, then go to bit.ly, Movin Beta, and put in your details, and I'll send you an account. You can try it out. After that, I can swear to you, even though you're not a YGen, you'll never go back to your basic checking account once you've used this smarter bank account. It's addictive. You want to find out what that receipt's, how much have I spent today on coffee and taxis? And I know how this thing works, and I was still shocked at how much I spend on this stuff using this. So that's at the core of where I think this evolution's going. Let me put it really simply. This shift in behavior from customers means that banking's no longer a place you go. It's something you do. And this is this layer of technology that's been created now. This is consumer behavior that's been enabled. How we do banking every day is what's changing right now. And the branch will still survive, but it's going to be a supporting service channel. It's not going to be your primary day-to-day relationship channel. The size of the branches will shrink dramatically. The teller function will come out. The service component will still sit there because psychologically we still need that crutch of if something goes wrong, I need to go and scream at someone so I can get my money out of the bank. We still need that service component if something goes wrong. But the frequency with which we visit those locations and how that plays in respect to our choice of product or our choice of retail financial service provider will dramatically shift to the point where 80 to 90% of our revenue by the end of this decade will come through non-branch means. And that is a dramatic change in this business. And it's going to happen in the next 5 to 7 years. We don't have long. If you guys don't do it, then Bluebird, Amex, PayPal, and all those other guys will be happy to do it for you. But you can do it as well. Just think about what your customers do with the bank and enable that. That's what I think is the future of retail banking, or Bank 3.0 as I like to call it. Thank you.